Hello and welcome to an FXTimes daily video recap. I'm your market analyst, Nick Nassad. Today is Wednesday, February 17, 2010. Today's key theme was a reversal in the euro gains we had seen in Tuesday's session, as we had a positive string of US fundamental data which helped to boost the greenback. It increased speculation that the Fed may lift interest rates sooner than anticipated. Yesterday, we saw the euro-dollar pair rally as we had rally in commodity prices and equity prices, which boosted risk appetite and helped the euro to gain. However, the markets may have thought that this rally was overdone as the Greece problems in the eurozone remain. Today, we had fundamental data from the US that showed better than expected US housing starts as well as industrial production data, and that helped the greenback to rally on interest rate outlook. The data pretty much showed that the economy in the US will rebound before the European and Japanese ones will. Also, rising US Treasury yields in the wake of the economic data added more pressure on the yen and the euro by making dollar-denominated assets more attractive. So yesterday we tested the 1.3790 area, which was just below this level of resistance we had been looking at in yesterday's video. We fell back down to test our low from Monday's session, just around 1.36. And that is where we are around 2:30 p.m. Eastern Standard Time. Zooming this pair out, we see we've had a very steady decline in the euro against the dollar, but now we are seeing some sideways trading as perhaps the dollar is consolidating its recent gains. Now we're testing the lower bound of this consolidation zone, and let me highlight it with the rectangle tool. And so if we move below this level, it could be an indication that the greenback could rally further. In yesterday's video, we took a look at the dollar-yen pair and showed how we were testing the 61.8% retracement of this sharp slide we saw 2 weeks ago. Today, the greenback rallied strongly, reaching this resistance level right around 91.20. So that now we have completed a 100% retracement of this fall. We could draw a support trend line connecting our lows here. But also if we zoom this pair out, we could see that if we draw a downward sloping resistance trend line connecting our main highs in early January and early February, we could see that today in this week's action we have broken above that level. So now we look for our horizontal resistance to see what the pair will do next. If we have perhaps moved downward, but if we do break this, then we could see definite further gains for the greenback. So let's take a look at the US fundamental data that helped to spark this greenback rally. Housing starts in January rose to an annual pace of 591,000 units, which was better than expected, plus December's figure was revised higher. Building permits, meanwhile, decreased to 621,000 annual pace, and building permits are a leading indicator for future housing starts. However, that number did match expectations, so it could still be considered a decent reading. The data shows that an extension of the homebuyer tax credit is likely to boost demand in the coming months. However, if we do take a look at our graph to the right, we see that housing starts have been sort of stalled in this just below 600,000 level for most of 2009 and now in 2010. So you could see this 5-month average trend line is moving sideways currently. On the downside in the housing sector, we're still facing mounting foreclosures and a very high unemployment rate. We also had industrial production data come out for January, and we had a 0.9% increase over the month from December. That was better than expected, plus we saw December's reading revised slightly upward as well. The capacity utilization rate, or the proportion of factories in use, rose to 72.6%. If we take a look at our chart to the right, we see that we've had 7 straight months of industrial production increases, and the annual rate is now above 0%. The manufacturing sector has been at the forefront of the U.S. economic recovery. The gains this month were led by a 4.9% increase in car and auto part output. So again, those two pieces of data favor a stronger U.S. recovery and means that the Fed may be inclined to raise interest rates sooner than currently anticipated. In a look at the pound dollar pair, we see that the pound slid in today's trading as well, giving up its gains from yesterday's session. We had poked above this resistance level at 1.5765 or so, and we had stayed above that in overnight trading, but following a weaker than expected jobs report from the UK, the pair did slide. However, we could plot a bit of a upward sloping support trend line, which we stayed above, though we did move below our 50-period moving average. So we have slid back into this consolidation zone we have been following the last 2 weeks. The unemployment report I mentioned was the claimant count for the month of January, and it showed that 23,500 more workers asked for unemployment benefits, and the total number of those receiving unemployment benefits rose to 1.64 million, which was the highest level since April of 1997. The ILO unemployment rate, which was for the month of December, remained at 7.8%. That figure is running at 9.7% in the US, 10% in Eurozone, and 5.1% in Japan. The last couple of readings had been showing some improvement in the labor market, but the Bank of England did say last week that employment is at risk of falling significantly further if the economy's recovery from the longest recession on record falters. We also today had Bank of England meeting minutes come out, and it showed that it was a unanimous decision to suspend its bond buying program in February, though it was a close call. The Monetary Policy Committee judged that a case could be made for extending the quantitative easing policy if conditions warranted. That would go hand in hand with its warning last week about employment in case of a double dip recession. In a look at the Australian dollar US dollar pair, one of our commodity currencies, we did see a move above the 0.89 level in this week's trading, and compared to the euro and the pound, the decline here was much smaller. We tested our 50-period moving average, and we found support there. So a bit of a pullback to this rally, but a significantly smaller pullback than what we experienced in the euro dollar or the pound dollar pairs. We can see that this resistance level lines up with this consolidation we had in late January. Zooming this pair out further, we see that the pair has been retracing this down move that we had seen throughout most of January, and currently we're testing a 61.8% retracement of that down move. So that's an important level to watch, right where we turn back in today's trading. The US dollar Canadian dollar pair also saw a correction to its slide yesterday, as we found support at the 1.0410 area. So the market may be waiting to see how trader sentiment and investor sentiment pans out for the rest of this week to see if we have a further move in favor of risk appetite, which would benefit the Canadian dollar, or if we see further greenback strength and the move higher up to perhaps 1.05 or 1.0550. Now let's take a look at the upcoming fundamental docket. Tonight at 11 p.m., which is a tentative release time, the Bank of Japan will hold its interest rate decision. Overnight, Switzerland posts its trade balance as well as its ZEW expectations, while the UK will release data on government borrowing, money supply, and industrial orders. Tomorrow, Canada posts its consumer price index, as well as international security transactions, which is a measure of securities bought by foreigners. In the US, we get the producer price index, our weekly jobless claims, Philadelphia Fed manufacturing index, as well as the Conference Board leading index. So another relatively busy day for US fundamentals. And that will do it for today's recap. For more news, videos, and analysis, please visit our site FXTimes.com. Again, I'm Nick Nassad, and I want to thank you for watching and wish you good trading.